All right, let's get right into it. Today, we're taking a close look at PowerFleet's first quarter since its massive merger with Mix Telematics. This is our very first real glimpse at how this new, combined company is performing under its new ticker, AIoT.
So, the big message from management? It's pretty clear. The heavy lifting of the merger is done. They've moved past the planning stage, and now it's all about execution. And those cost-saving synergies they promised, they're already starting to show up in the results. But here's the million-dollar question for all of us, right? Now that the dust from the deal is starting to settle, is this stock actually a good buy? That's exactly what we're going to break down today.
Okay, so let's start where you always should, the headline numbers. These are the big figures that really set the tone for the entire quarter.
First up, total revenue came in at a solid $75.4 million. That's a healthy 10.2% jump compared to last year, which is a great start. But honestly, the really juicy part of the story is when you look at their profitability.
And get this, adjusted EBITDA, that's a key measure of profit, was up an incredible 52% year over year, hitting $13.7 million. That is a massive signal that this merger is already unlocking some serious operating leverage.
And you want to know how they're doing it? Well, here's the big piece of the puzzle. They've already locked in $8.7 million in annual cost savings. I mean, that's some seriously fast work, and it shows they are laser-focused on making this integration a success.
So, let's build out the bull case here. The whole positive story really boils down to one thing: executing on the promise of the merger. The idea is to create this scaled-up powerhouse in AI-driven IoT solutions that can deliver some real profitable growth.
Management has this really simple but powerful strategy they call the growth flywheel. Step 1, integrate the two companies. Check, they're doing that fast. That lets them move to step 2, which is scaling up their main software platform, Unity. And when you have a powerful, scaled-up platform, well, that's how you get to step 3. You attract the big-time global partners.
And believe it or not, this isn't just a theory. It's already working. They just announced a new partnership with MTN Business, a huge network provider in Africa. The CEO called it a force multiplier, and he's right. It proves the platform works and opens up a massive new market for them to go after.
Now, if we dig a little deeper into the numbers, something really interesting pops out. The quality of their revenue is shifting. See, that high-margin recurring service revenue now makes up a record 83% of their total sales. This move to a software-as-a-service, or SaaS model, is exactly what investors love to see, because it means more predictable money and better margins. And look, this is more than just numbers on a spreadsheet. The Unity platform is delivering real, tangible results for some huge clients. For the materials company Holcim, it led to an incredible 83% drop in critical safety incidents. For Foley, it cut maintenance cost by 30%. I mean, this is the kind of real-world return on investment that gets big companies to sign on the dotted line and stick around.
All right, but let's be real. It can't all be good news, right? We have to look at the other side of the coin, because there are definitely some legitimate risks and headwinds we need to talk about.
First up, earnings per share. Now, on an adjusted basis, they broke even, 0. But you've got to look at the official GAAP number, which was a loss of 21 cents per share. Now, yeah, that was because of one-time costs from the merger, but a loss is still a loss. The market's going to want to see a clear path to actual GAAP profitability, and soon.
So this really sets up the central dilemma for any investor looking at PowerFleet. It's like a tug of war. On one side, you have management with this super ambitious goal of hitting the Rule of 40 in 2 years. That's a key benchmark for software companies. But on the other side, you've got the market staring at over $100 million in net debt, some potential customer churn, and just general economic uncertainty.
So, you got this really compelling bull case on one side, and some very real risks on the other. Where does that leave us? What's our call on the stock? The big question we all have to ask is this: can the momentum they're getting from the merger synergies and the switch to SaaS sales overcome the drag from their debt and the shaky economy? That's really what it all comes down to. Okay, so we're going to give this stock our outperform rating. Before we get into the why, let's just be super clear on what that means. It just means we expect the stock to do better than the overall stock market over the next year. So with all that said, our rating is officially outperform. And here's why in a nutshell. They're capturing those cost savings way faster than expected. That strategic shift to high-margin software revenue is picking up steam, and the fact that management actually raised their guidance for the full year, that tells you they're feeling very confident. Okay, so how would you actually trade this?
We're calling this the outrageous but plausible trade. The core idea is that the market is still punishing the stock for the risk of the merger, but that risk is disappearing faster than people realize. We think the entry point is right around current levels, and the price target is based on them hitting their 2025 goals. So what are you watching for? The next earnings call. If they can show another great quarter of service growth and prove they're starting to pay down that debt, we think the stock could really take off.
So the key question now is, can they keep this momentum going? This next quarter is going to be absolutely critical to prove that this merger wasn't just about getting bigger, but about getting a whole lot better. And as always, remember, this is not financial advice. Please be sure to do your own research.